Trader gang. What's up, team? How are you guys doing today? Hope you guys are doing well and hope you guys killed the markets. So in today's video, I'm bringing you back not a day trading video about my recap, but I'm going to be talking about risk units. I'm going to be talking about money management and risk management and all the important stuff involved. In my opinion, I think trading in R's and risk management, trade management, money management, all that in one collection is the most important thing in day trading and also in order to be successful. Strategies might be there, but in order to preserve capital and just understanding the importance of that is definitely key. Anyways, my name is Jason from Mining Trades. Please stay tuned. All right, gang, what's up? So before we get in, if you could do a couple things for me right now, if you could like and subscribe, that definitely helps out. Also, while we go through the video, if you have any questions, feel free to leave a comment below and I'll get back to you immediately. Now let's get into the video. So risk units, today we're going to be talking about a few things. Risk units, what are the benefits? We're talking about money management, daily goals and max losses, how to calculate risk units, and I'm going to provide you some examples. All right, so risk unit, what is it? So essentially, a risk unit represents the dollar risk taken in any given position and is the amount you're willing to lose per trade. It's a powerful tool used to mitigate and manage risk, but also used to accurately track trading performance. So to get it here, the dollar risk in any given position. So what we're trying to say here is we're not trading in dollar value. We're trying to mitigate and reduce the amount of risk exposure when we're trading. Therefore, when we're trading in R's, everything is the dollar amount. It's all the same. Doesn't matter if you're risking 1 R or $1, $100 or $1,000. If everything is equal, we're trading in R's. Also, when we're trading R's, it's easy to mitigate or also track the performance of how you're trading because you're not really talking about dollar values, you're talking about risk units. Right? And if everything's in a risk unit, doesn't matter if you're scaling up or scaling down, everything's all relative because they're tracking the same dollar value per trade. Okay, and one thing to note, many traders size up and risk too much money too soon. And a lot of new traders do that, right? Once they get their account, they want to start making money fast. They think this is a get rich quick scheme, right? Wow, I could trade or I could turn $1,000 into $10,000. I could trade 500 into $1 million in 90 days. No, get out of here. That is silly. Okay, so just note, don't trade size, right? We're only trying to trade small size until you prove to yourself that you can scale up. But we'll talk about that in a bit. So the benefits of trading in R's. So why should you use this method? Well, this method is very important. I always trade in R's. You should also. So one of the key things, number one, is the appropriate position size, right? So this helps you prevent taking fixed share size. Also, each trade is traded equally and no trade is valued worth more. And also, a trade shall never exceed the risk, right? So when you're trading a fixed share size, say, I'm going to take 400 here. I'm going to take 300 shares here. I'm going to take 450 shares here. I'm going to take 10 shares here. How does that make sense, right? Even if you have, say, a 1-to-1 reward to risk, it's not going to be the same, right? Because you're risking $500 in this trade, but then you're risking $300 in this trade. Then you're risking $400. How does that make sense? How are you going to track your performance, right? If everything's not equal in risk, if you're not trading the same dollar value, you're not going to know your true performance, your true value, your batting average, right? So that's why it also comes down that each trade is equal and not should be valued more, right? So if you take 3 straight trades, say you're risking $100, you win 100, you win 100, you win 100, and your next trade is like, okay, I'm going to risk 500 on my 4th trade because I'm on a hot streak, and you lose that trade and you're down 500, that means you had 1 trade that wiped out 3 days of gains or 3 trades of gains. How does that make sense? No trade should be valued more. Even if the setup's there, no trade is valued more, right? This is a game of probabilities. And that also follows into the next step. No trade shall ever exceed that risk, right? So keep that in mind. So number 2, you want to keep that loss consistent, right? No loser should ever be larger than 2 hours or 3 hours and 4 hours. Or in other words, blow up days or blow up trades, right? Never, because that is ridiculous. That's basically indicating that there's a serious flaw in your trading. Something that needs to be revised or something needs to be looked at, because that's an immediate danger. You're basically, at the end of the day, trading, you're supposed to protect your capital, protect your gains, and protect your capital. I'm going to say that again. The reason why, because once you run out of capital, you're not going to trade anymore, and that's it. You're just going to be another statistic that basically went out the window, right? Some trades you might lose 1.1 R, 1.2 R due to slippage, and that is fine. Of course, the spreadier the stock, there's going to be some slippage involved, but always give that little extra room to account for that. But that's in a different video talking about that. Number 3, we want to identify the success and failure rates. So strategies based on time or so whether it be like daily, weekly, monthly, and so forth, specific strategies such as buy setups, sell setups, wedges, triangles, breakouts, parabolic plays, and so forth, right? So it doesn't matter if your dollar value, we already talked about this, 1 R is 10, right? If 1 R is $10, you return 10 Rs in 1 week, basically you have $100, or that is 10 Rs. Same thing as 1 R or 1 risk unit is $100, you return 10 R, that's 1,000, right? You see the difference there? $100 to $1,000 is all the same if you're doing it in Rs. So don't think about that dollar value. And the next thing, number 4, why we should use trading in Rs is because the scalability, right? You want to earn the right to raise the risk, right? So say if you're on a hot streak, you might want to bump up your risk the next week, right? And if you keep on continuing that trend and you notice that you're trading really well and you're getting rewarded, you have the right to raise that. But on the flip side, if you notice that you're losing money, that doesn't mean you should increase your money, right? You should increase your risk. If you know that you're going on a slump for 2 weeks, that does not mean that you're going to try to all make it back the next week. You're going to actually reduce that risk until you get back into that groove, right? So let's talk about the next slide. Scaling. So reward yourself. This is definitely key. This is how you become a $100 trader to a $1,000 trader. Not overnight, slowly through dedication, hard work, and reviewing your trades and sticking to your rules. Okay? So as you can see here, dollar risk, right? So I'm using an example of if you return 10 Rs per week. So if you return 10 Rs by the end of the week, you want to scale to the next dollar risk the following week, right? If your 10 R is not reached by end of week, you want to continue to achieve the next week. If you achieved it on week 2, you don't want to start the next scale up factor until week 3, right? Because that gives some buffer room. On the flip side, you want to do the same thing. If you're doing poorly and say you reach minus 6 R in 1 week, you want to scale down. But then also you want to reevaluate your trades, right? Your trading. What did you do wrong? What are you doing wrong? Is it just the market? Is it my psychological factor? Is it maybe I'm just being compulsive and taking not my sit-ups and not sticking to my rules and so forth? A lot of factors, so definitely reevaluate your trading. Okay, so for example, let's just say we're doing $50 risk, so $50 1 R. On week 1, I come and achieve return 12 R. The following Monday, I'm gonna boost my risk to $75 per trade to $75 per trade is 1 R. The next week, I kill it again. Wow. Basically, I returned 20 Rs in 2 weeks. On week 3, I'm going to boost my R factor to $100. Right? So now each trade is worth $100. If you kill it again, so forth, 125, 150, 200. On the flip side, right, if you're doing $50 and you notice that you might buy 6 R before the end of the week, you're going to reduce your size to $30 a month, right? And then reduce it to $20 and reduce it to $10 and so forth if you're trading bad. And definitely that is the key to reevaluate your trade. But anyways, that is how you would scale your trading. Now let's get on to the next topic. Money management. So money management, why is this important? Well, first off, money management important is because you want to identify the reward to risk per trade. Ideally, you always want to aim for the minimum of 2 to 1 reward to risk. 1.5 to 1 makes sense, but 2 to 1 is ideal. And not only that, is that you never want to risk more than 0.5% on a trade per account size. Even 1% per trade per account size is kind of tipping the scale, because that's just essentially saying that if you take 2 straight losers, you're down 2% on your account. That is a no-no, right? And not only that, if you're trading 0.5% per account size, you have the ability to take more than 1 or 2 or 3 trades at the same time, but that is not recommended for beginners. Number 2, control risk. Always use a technical stop loss, stop market order to fill, and also respect that stop loss. So what I mean by that is that you always want to put a hard stop in place. So if you get triggered out, you get triggered out, and then you're going to hit that -1R factor. If you don't and use a mental stop, you might be like, oh, I'm going to give it a couple more seconds. I'm going to need a couple more seconds. Next thing you know, you're down 1.5R, 2R, 3R per trade, and then you're just holding the bag. And that is against anything with risk management and trading in Rs. And then that goes back to, if you're losing more than 2 Rs per trade, there's a serious flaw in your trading. So reevaluate. And then number 3, with money management and trading in Rs, you can set goals and max loss. So have a plan for daily goals. Maybe you want to turn 4R a day. That's your daily goal. Or your max loss. Maybe your max loss is -3R a day. Once they shut it down. Right. And inexperienced traders should never risk more than $10 per trade. Keep that in mind, $10 per trade. So that is from when you go to demo and then you transition to real money. Never risk more than $10 per trade. Ideally, I say that you should risk $10 per trade until you're comfortable, until you hit that 50R return. Then you can start making real money. And achieving that 50R might take some time. It may take a month, may 2 months, 3 months, and so forth. But it doesn't matter, because at the end, this is a long-term gain. Get that in your mind. Long-term gain, right? Base hits. This is not a get-rich-quick scheme. All right, so next we're going to be talking about daily goals versus daily max loss. So what is the plan? So for example, I set up a daily goal and daily max loss examples here. So we'll start off for the first one for daily goals. 3R a day. Once you hit 3R a day, you want to immediately stop, take the rest of the day off. So this, you may hear this quite often, the day trader's lifestyle, right? So if you hit the goal, it doesn't matter if it's within the first 5 minutes or maybe the first 5 hours. Once you hit that goal, you want to take the rest off the day and come back tomorrow. Enjoy the rest of the day, right? Don't even think about trading. Or you have the section option, which is you hit the goal and then you continue trading. However, trade using half R until you lose 2 trades. So this gives you the option to be flexible to continue trading. Because say if you're done within the first 5 minutes, charts haven't really fully developed yet, right? So there might be some further more opportunities to trade. That's why you want to trade half R risk, right? So you might end up the day 4R, 5R, 6R, or so forth. But if you do end up taking 2 losers, you'll be back at 2R. You're still green for the day. Take the rest of the day off and then come back tomorrow. I would recommend option 2. For daily max loss, we have 3 options here. Not 3 options, but 3 different scenarios. So for the day, if you hit -3R, you want to immediately stop and take the rest of the day off to reevaluate. That doesn't matter if you actually hit the 3R within the first 5 minutes or the first 5 hours. You want to take the rest of the day off. This is because maybe your psychology is not quite there, your psyche, or maybe the day is just not going well. And once you hit that red day, you want to stop and limit yourself, because you want to stop trading because you're not thinking correctly. Also, the end goal is to preserve capital, and this is what happens. There might be days when you're like, you know what, I'm not going to do this. I'm going to come back. And you might actually come back red to green. You might go -3R to 3R. But in most cases, that -3R will turn into -6R, -9R, and we've all been there before, right? So that's why you want to stick to this rule. For the week, if you're down 6R, you want to immediately stop and take the rest off the week. So on day 2, say you hit -3 on day 1, -3 on day 2, you're done for the week. You're not trading anymore. You're taking the rest of the week off to reevaluate what you did wrong. So maybe on day 3, 4, and 5, you're going to go back to the demo platform and trade that. Now, let's move on to the month. If you're down to minus 12R for the month, you're immediately going to stop and take the rest of the month off. Okay, so even if you hit minus 12R within the first week, you're taking the remainder month off to reevaluate what you did wrong, because something is going wrong and you definitely had to switch something up. Not only that, upon your first week of return, you're going to be trading half hour until 5 hours return. That is just to ensure that you slowly get back in the groove. Because when you're trading demo, sure, that works, but when you're trading real money, it's a bit different, right? Because actually money is on the line. So that's a factor. Trade half hour until 5 hour is returned. All right, next on the item is we're going to be talking about calculating the risk, right? So there's, of course, the calculating the long and the shorts. So essentially, it's the risk divided by entry minus stop is the share size. So the risk is the share size you're willing to trade, or the share size you're using to fulfill that trade, right? So I have 2 long examples here. If your entry going long is 100 and your stop is 98, you're risking $100 per trade. You're taking 50 shares, right? So entry is 100, your stop is 98, your risk is 100, you're trading 50 shares. Furthermore, same thing, if your entry is 40.50 and your stop is 40.10 with a 40-cent stop, you're risking $250, you're taking 625 shares on your entry with a stop of 40.10. On the other side for shorts, if your entry is 100 and your stop is $2 at 102 and you're risking $100, your share size is 50. So your entry is at 100 and you're putting that stop loss at 102, right? And you're willing to lose 150 shares. Same thing with the short, 31.50. Your stop is at 32.25. You're risking 75 cents with $25 risk. Your share size is 33 shares. So it's definitely all the same thing. And of course, you want to always round down share size to reduce the overall risk. So for example, this might be 633, or this might be 55 shares. Just round down. Makes life much easier. Okay. So now we're going to move on to the examples. So right here is a long example where we talk about the profit target is not fixed, right? So in most cases, when you trade, you want to know your profit targets. You want to know what your reward to risk is, right? We want to look for that 2R minimum. So before we get into a trade, you want to have a trading plan, your entry, your stop loss, and your targets. So for this example, there's no target set in stone, but your entry is 1990. So for trade 1, we're risking $200 per trade. $200 is 1R. Your entry is 1990. Your stop loss is 1965. So in order to trade this with a $200 risk, you'll need 800 shares because you're risking 25 cents. But is that really worth it? Look at the profit target, right? Your target's maybe 2015 for 1R. For 2R is 2044. And 3R is 2065. So you see this? It's such a tight stop that in order to get that reward, the tighter the stop, the reward is greater because it doesn't have to move as far. But if you want to have a looser stop, we might want to put it at the next pivot, which is trade 2, right? So still the same parameters, $200 risk. Your entry is 1990, but your stop loss this time is 1942. And your dollar risk is basically 48 cents with you only need 415 shares. But as you can see here, now your 1R is moved up to 2038 as opposed to 2015. Now you have to go to 2038 to hit that 1R. And to hit 2R, you need to go to 2086 rather than 2040. So the tighter the stop, the higher reward, but the higher the risk, right? You might have more chances getting chopped out here, and then you have more room, more flexibility, right? But it is what it is, depending on your personality of trading. Next example, we're using a short example, but with a profit target fixed at $97. So we know that, say this is the target, $97. Maybe there's a daily pivot here that wants to go to $90, right? So our entry here is we're entering on a triangle, right? A triangle base breakdown, and we're going to enter once it breaks that whole number. So the entry is at, for trade 1, the entry is at 98.99. We know that stop is at 99.52. So for the $200 risk, we'll need 375 shares, basically with a stop right at this pivot. In order to get down here, that's a 3.8 to 1 rewarded risk. So that's almost a 4 to 1 risk reward trade here. Very tight stop, but makes the most sense considering that this is the long base. If you want to be a bit more flexible, we have this option at the second pivot where we enter at 112, or I mean, sorry, entry is still at 98.99, but it stops at 112. We'll need 175 shares with a dollar risk of 113. And for that target is 1.7 to 1 reward to risk. This might be more suitable if your account size is kind of lacking because you're required less share size, therefore less overall capital to trade. And then the third trade, of course, is the most furthest, the most flexible one. And essentially this is a 1.3 to 1.1 trade. Right, so you kind of get the gist there. You have 3 options, right? The options is, of course, the pivots. That's always where you want to put the stops. There's also a pivot here you might want to put the stop, but I'm not even sure if that's a 1-to-1 trade there, so that is not valid. But like I said, this depends on your personality of style trading. Depends what type of trader you are. You know, maybe if you're up to R, you might want to be more flexible, or if you want the higher risk, or you're just having a good day. Really depends, right? And lastly, we just have another example, for example 3 at long. And this is just a test for you. So if our long entry is at 255.01 and our stop is at this pivot 250.29, where is the R1, R2, and R3, right? As you can see here, R1, or sorry, the target one, this shouldn't be R, stupid, but target 1, target 2, or 3R risk, whatever, should be here, 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 right? So depending on that risk, where do you want to go, right? If you enter here, where is it most likely going to go? Really depends on you, but you're looking for that 2R reward to risk ratio. And that concludes our video about trading in Rs. If you have any questions, please feel free to leave a comment below. Also, like and subscribe. If you have any questions or comments, I want to hear from you. Hit me up on Facebook, Instagram, and Twitter. I want to see you guys back tomorrow. Thanks for watching. Peace.